Coffee first. Markets can stay irrational for longer than you can stay solvent. Today we are going to discuss the risks associated with stock market investments. Now you might think you are well versed in the risk, armed with knowledge to shield yourself from potential losses. But the truth is, the risk landscape is ever evolving, presenting new challenges and opportunities with each market fluctuation. So buckle up as we embark on this journey together. I am confident that by the end of this video you will not have only a deeper understanding on investment risks, but also gain valuable insights into how to navigate them effectively. I'll walk you through each risk step by step, empowering you to make informed decisions and seize the opportunities that lie ahead. Hello everyone, this is Alex, private investment advisor, currently work and live in Portugal. Before we begin, as usually, small disclaimer: everything I say in this video or in future videos should not be considered as investment advice in any form. I'm required to say so in every video due to certain licenses I have. Thank you, and let's get started. Market risk, also known as systematic risk, refers to the possibility of investments losing value due to broader economic factors or market fluctuations. This risk affects all investments within a particular market or asset class. For example, during a recession, stock prices across various industries can decline dramatically due to decreased consumer spending and business activity. Inflation risk arises from the erosion of purchasing power over time as the general price level of services and goods rises. Investments with fixed return, such as bonds, are particularly vulnerable to this risk. For example, suppose you invest in a bond with 3% annual return, but inflation rises to 4%. In real terms, your investment is losing purchasing power despite a nominal rate of 3%. Interest rate risk pertains to the impact of fluctuation in interest rate on the value of fixed income securities such as bonds. When interest rates rise, bond prices typically fall and vice versa. For example, you purchased a bond with 5% yield, but interest rates rise to 6% in the market. New bonds are offering a higher return, reducing attractiveness of your bonds, leading to a decline in its market value. If you're an individual investor or business owner and you need a financial consultation, please visit my website, fill out the consultation form, and my assistant will contact you to clarify further steps. I provide consultations in various areas such as financial and retirement planning, brokerage account, investments, education, and hedging. Thank you, and let's continue. Credit risk, also known as default risk, arises from the possibility of a borrower failing to meet its debt obligations, resulting in financial losses for investors holding this debt instrument. For example, investing in corporate bonds carries a credit risk, as there is a chance that issuing company may encounter financial difficulties and be unable to repay its bondholders. Liquidity risk refers to the difficulty of selling investment quickly at its fair market value without significantly impacting the price. Investments with lower liquidity may lead to delays or price concession when it's time to sell. For example, investing in penny stocks or private placements can carry a liquidity risk, as there may be no buyers in the market when you want to sell your security. and could take a month to realize your shares. Currency risk, also known as exchange rate risk, arises from fluctuations in exchange rate between currencies, impacting the value of investments denominated in foreign currency. For example, you invest in a foreign stock traded in euros, but your domestic currency strengthened against euros. Even if the stock's value remains constant, its value in your currency decreases, affecting your returns. Political risk encompasses the potential impact of political events, instability, and policy changes on investments. This risk is prevalent in emerging markets or countries with volatile political climates. For example, a sudden change in political leadership leading to new regulation and nationalization can significantly affect the value of investments within the country. Reinvestment risk arises when cash flow from investments, such as bond coupons or dividend payments, need to be reinvested at a lower rate than original investments, resulting in reduced returns. For example, you hold a bond that matures and intend to reinvest your funds, but prevailing interest rates declined since the bond's issues, forcing you to reinvest at a lower rate. Concentration risk refers to the danger of having a significant portion of your investment portfolio allocated to a single asset, sector, or market, leaving you vulnerable in that specific area. For example, investing heavily in stocks from a single industry, such as technology, exposes you to concentration risk. If that sector experiences a downturn, your portfolio may suffer. Horizon risk relates to the potential impact of time on your investment portfolio. It involves the risk that market conditions or unexpected events may not align with your investment time horizon, affecting your financial goals. For example, you plan to retire in 30 years and invest in stocks for long-term growth. However, a major economic recession occurs just before your retirement, leading to a significant decline in your portfolio value. Longevity risk arises from the possibility of outliving your financial resources, particularly on retirement. It refers to the risk of inadequate savings or investment returns to sustain your desired lifestyle for extended period. For example, you underestimate your life expectancy and exhaust your retirement savings sooner than anticipated, leaving you financially vulnerable in your later years. In conclusion, understanding and managing investment risks are essential component of building a resilient investment portfolio. Remember, while risk is inherent in investing, informed choices and diversification can help you to navigate in turbulent market conditions. That's all for today. Thank you. Until then, spend your money wise.